Good morning, everybody. How you doing? Welcome to Friday. Woohoo! TGIF, baby. It's Friday. Oh, I'm so glad to see that. We have survived almost another week, 4 days down, 1 day to go. Today is Friday, May the 21st, 2021. I welcome all of you to the show. Is there any real difference between picking up a contract on IPOE just in the money at 1750 or just out of the money at 20? Davey, that's a good point. That's a good question. I mean, these are the dilemmas that you might be faced with from time to time when you're looking at how to play a market. And I would go farther than this, Davey. I would say this. Look, IPOE right now is 1879. All right. So you're talking about the idea of buying a 1750 contract, call contract, or buying maybe a 20 call contract, or 2250, or maybe a $15 contract. So if you're going to buy a $17.50 contract for, say, next January, it's in the money right now. Obviously, the stock trading at 1879 is $1.29, let's round it up, $1.30 in the money. So don't be surprised if the contract is 350 or 360 or 380 or almost $4, because there's time on top of the book value. The book value from 1750 to 1879 is $1.30, and then the contract still has until January until it expires, and that's 7-8 months. If you bought a 20, it's out of the money because the stock at right now 1875 is $1.25 out of the money, behind $20. So the contract is ahead of the price of the stock for exercise price, but it's a January contract, so it's got the time, but it doesn't have the value. So you're not going to pay as much. It won't trade as high a price as the 1750, and that's typical on any stock, any option contract. Take a look at quotes. You'll notice that any option contract just in the money versus one that's just out of the money, one is more expensive than the other. The one that's in the money is always more expensive than the one that's out of the money for the same expiry date. Okay, but if you can buy the $20 contract for, say, $2.50 or $2 versus $3.50 or $4 on the other one, on the 1750, you might be able to buy double the number of contracts. And here comes the game of, well, I have a limited amount of money. I've got $1,000 I want to play with here on IPOE or any stock, but let's say IPOE. I have $1,000 and I want to get as much leverage as possible, but I also want the best performance for the contracts I do buy. So in theory, I could buy 1750s or 20s or 2250s or 25s. And they can all be for next January, for example, same exact expiry date. Which ones do I get and how many do I get? And so if you buy, for example, two 1750s, they'll run you like $850. You can't get a third one. That's 200 shares of leverage. If you can buy four 20s, because they're trading around 225 to 250 a piece, I can get four of the $20 contracts. That gives me $400 of leverage, 400 shares of leverage between now and January, because I have four contracts versus two contracts. Except that the 1750 contract that I would have two of is in the money now, and this stock goes up another couple of bucks a share to just $20.75. This 1750 contract is in the money more, and so it will move further quicker. For every dollar the stock goes up in value, this contract will likely go up 75 to 80 cents in value for every dollar for the next $4 or $5 at least. And from there, if it goes higher, it'll go up in value 80 to 85 cents on the dollar, because the premium will shrink ever so little as it keeps going higher, to the point where if you take a look at, say, a 1250 contract or a 13 contract, a contract well in the money, more in the money than the 1750, go back lower, you'll find that the time premium is less, book value is more, and you'll begin to figure that out and go, oh, I see what he's talking about. That if the stock goes up $1, a $12 contract will go up probably 90 cents in value, whereas the 20 will only go up 60 cents in value, or the 1750 will go up 70 cents in value. So keep that in mind. All right, that's one. Two, stock goes up a couple of bucks a share. The 20s go up too, obviously, because the 20s are only $1.25 away from the money. And obviously, as soon as you hit $20 a share on IPOE, if that were to happen, your contract is at the money. It's a $20 contract, $20 stock price. You're going to be all premium at that point, and that might be $2.75 or $3. And then from 20 to 21, the contract will go up 75 cents in value, perhaps to 375. If the stock goes to 22, it might be 450. So it's $2 in the money with 250 premium, and you'll see the premium begin to shrink back as it goes higher. But you got 4 contracts versus 2 contracts. The 20s, you could buy 4 of them. The 1750s, you can only afford to buy 2 of them. And so now you have to ask yourself, which way do I go? Or do I even go the 2250s? If I believe, I have the hunch that between now and next January, these shares can reach $30 a share because the book value of SoFi and Ipoe is $27 upon listing. That's next week. And the stock will reach that level and then trade at a premium. And you feel that $30 is an easy target price, which is my personal opinion. That's an easy target price. So if it reaches 30 a month from now, 6 weeks from now, great. You still have 5-6 months of contract life left. The stock's at $30. You have a 2250 contract, but were you able to buy 6 or 8 of them instead of 2 or 4 of the 1750s or the 20s? If you've got 8 contracts that are now $750 in the money, they might be trading at about $9 a piece, and you've got 8 of those, and you paid maybe $1.50 a piece for them. We're talking about lower acquisition cost, maybe $125 acquisition cost, $150 acquisition cost, but with a $9-10 contract value, there's some real leverage here. On the 2250s, you might have 4 of them, but they're at $20 contracts. You have 4 of them, and they're 10 in the money plus premium. They might be trading at $11.75, $12. You're up 6 times your money there, and that's a pretty quick, solid gain. On the 1750s, you bought 2 of them. They're $12.50 in the money, and they could be worth about $14 on the open market. And you paid $3.50, $4 a piece. You've made some really good leverage. So the leverage is better, perhaps further out, but don't quote me on these prices. I am guessing. I'm not looking at the option chain right now with you. You have to look at them yourself. You got to get a calculator out. You got to get a pencil and paper out, pen and paper, whatever you're doing, and figure out, okay, if I buy the 1750s, this is the cost. If I buy the 20s, this is the cost. If I buy the 2250s, this is the cost. If I buy 25s, this is my cost. Which one should I get for the amount of money I have? And if this is all the money I have in the world to gamble with, I got to be right this time on this deal, because I don't have $50,000. I'm throwing $1,000 at this thing. I got $1,000 and I'm throwing $1,000 at this thing. Where's my payoff and what's my risk tolerance and what am I comfortable doing? That's the trick, because on an option contract or contracts, however many you buy, you're risking all your money. You could lose every dime if the stock does not perform, or it does perform, you don't get out, you're greedy for more, and it backs all the way down to below your book value. You lose it all. So you have to be cognizant of that. Now, this scenario, this situation with Ipoe is a unique situation because it is a company being taken over by another company. It's a full-blown merger takeover. And this publicly traded company will be worth a lot more money as a combined entity than it is right now. Ipoe has value today. It's a $1.75 billion market cap right now. But as a SoFi company, it'll be market capped at about $8.5 billion. Let me just say, it'll be book valued at $8.5 billion. The market cap will depend on where the stock trades. So if the shares trade at $30, it could well be market capped at $20 billion or higher. That doesn't matter in one sense, because you just want to know what the stock can do, and you've got options against it, and you're writing leverage. And that's the point of options. The point of options is to get leverage. Now, I'll say one more thing. If you have $1,000 and you can acquire stock, you can buy the stock with $1,000. You're only going to be able to get about 60 shares right now. That's about it. And if they go up $10 a share, you're up $600. They never expire, your shares. They're good forever. The stock goes to $100 a share down the road. You've got 60 shares. You get $6,000. But if you're controlling 200 shares through 1750 contracts, the stock goes to $30. You're going to be sitting on $2,800 of the contracts, and you paid $1,000 to get in. So you've made 2.8 times your money. You can pick off 4 or 6 $20 contracts. You can get 4 or 6 20s, maybe 5 20s. Goes to $30, that's $5,000 in value, and now you've made 5 times your money. Again, I'm not telling you this is exactly the deal. I don't know because I don't have the quotes from. Do this homework. But if you can get more contracts with more leverage within a reasonable spread here from the market, from one contract to another, the evidence or the answer for you might be with limited resources. My number is $20 a contract, or $22.50 is the contract, because I can get more leverage and I'm prepared to take that risk. And I've got till next January to make this happen. And between now and next January, I'll have another couple of thousand to put into the market to try something else if this doesn't work out. Because you got to think about this, your budget, and I'm saving $200 a month or $300 a month towards my investments, and I'm happy to take option flyers right now. I'm younger. I want the leverage. I'm happy for this action, and so I'll go to the 20s or 22.50s to get more contracts with the amount of money I have available. And even if this doesn't pay the way I hope it pays, I only break even, or I make 50%, I double my money, or I lose half my money. Between now and January, when these contracts expire, if I don't do a darn thing but wait this out, I'll have another 1,000 or 2,000 to play with anyway, and let's see what I can do next. So I hope that's an answer you can handle. Thank you. Thank you, everybody, for that. If you'd like to talk to me about a 1-hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.